Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers. Now, right now, you guys, as of May, inventory is up. Are you ready for this? 10%. Do you guys remember just 3 months ago, oh, how is inventory going to go up? It's never going to go up. You guys, we're already up. 3 months later, we're up 10%. And come June, once the numbers come out in June, you guys, we're going to be up even more. Not to mention, Zillow is now flip-flopping once again and downgrading their projections on the housing market and the equity growth. So they're flip-flopping again. Nevertheless, we're going to go over the data from Zillow. They still have really good data, you guys. I just don't like the conclusions they're giving. I think that they should warn and prepare Americans not be overly aggressive on equity growth so people continue to buy overpriced houses before the market resets. So we're going to go over a Zillow article today titled Housing Affordability Hits 15-Year Low as Prices, Mortgage Rates Rise, May 2022 Market Report. So you guys, by now, the data is now overwhelming. There is no denying that all of the pressure and all the forces are now trying to push the housing market very violently and very quickly into a buyer's market, or as the Federal Reserve Chairman Jerome Powell says, reset, right? I'm saying crash or negative equity growth. But you guys, here's the thing, relax. You could do something about it. You don't have to get caught up in it like I did. You don't have to be a victim. You could be a winner if you sacrifice, show self-discipline, and properly prepare to the best of your ability. But before we get started on this article, you guys, please like this video. Understand I'm just a YouTuber. I'm not a financial advisor. Please like the video, subscribe if you haven't, comment. You guys know my bio is as a realtor, loan officer, and educator in all things real estate. So I absolutely love empowering people about real estate. But let's get started on this article right now. Okay, a couple points we're going to start out with, guys, and it goes, mortgage payments are higher than rent in 45 of the 50 largest U.S. metros, up from 22 in 2019. So essentially, guys, it's no longer cheaper to own than it is to rent. It is cheaper to rent. Price appreciation is finally starting to slow. Thank you, Zillow. Easing slightly from 20.9 annual growth in April down to 20.7% in May. Inventory continues to recover from February lows, but is still 50% below 2019 levels. So inventory is so low, but you guys, here's the thing. On the rarely, like right now, it is smarter to rent versus own, like right now. Now, that's a super rare situation. Normally, it's a horrible idea to rent, but it is better to rent than be trapped in your house upside down, which potentially can lead to foreclosure, which can take 10 years to recover from. So if you got to rent a little longer to avoid those types of things, then rent a little longer. Right now, it makes more sense. Let's continue on with the article right now. Okay, guys, this is a chart. Let me read this. Ballooning mortgage costs driven by skyrocketing prices and interest rates have made mortgages less affordable than any other time since at least 2007. Demand for homes has pulled back in response, easing price growth, slowing sales, and boosting inventory. Thank you for being honest, Zillow. Mortgage rates shot up in early June, averaging 5.78% as of Thursday. It's now 3 basis points higher at 5.81%. The purchase of a typical U.S. home at that rate would mean monthly mortgage payments of $2,127. That's 51% higher than a year ago and 36% year to date. You guys, 51%, obviously that's not sustainable, but look at this. So essentially, you guys, here's that skyrocketing, mortgage rates and payments, right? So here's the skyrocketing payments. So obviously this is a massive surge. As you can tell, before that, it was relatively mild and balanced. Like it peaked here and then crashed down here and then slowly went up. But also look at this. This is the percentage of, payment increases. So it shot down. Do you see this, you guys? It shot down here because of the low interest rates. And this right here essentially is one of the factors that caused the housing market bubble that we're in. And then boom, here's the whiplash. So down and then whiplash back up 51.3% higher year over year. That is insane, you guys. In this area, when the crash happened, it went below. It was going down year over year. You see that? And that's what I believe is going to happen moving forward. I think this is going to shoot down, to go zero. But the thing is, guys, and remember, essentially the Federal Reserve started doing these things February of this year, the quantitative tightening. So as we move forward, it's only going to get even worse. So I believe that the reset, the crash, the correction is actually going to be a great one. And actually, it could be possible that it's worse than 2008 because of the way it was created and because of the lack of soft landing capability that the Federal Reserve does not have anymore, right? In 2008, they had the ability to do quantitative easing. You can make the argument we're in this situation today because of quantitative easing. Let's get back to this article right now. Incomes are lagging further behind fast rising mortgage cost, leading to the most significant affordability challenges in the past 15 years. The latest affordability data available from April shows monthly payments taking about 28% of homeowners' monthly income, dangerously close to the 30% threshold, beyond which is considered a cost burden. ZILLOW data from the metric is available through 2007. The Atlanta Federal Reserve's Home Ownership Affordability Monitor shows affordability bottoming out in July 2006. Although rents have soared since the start of 2021, the rapidly rising cost of mortgage still makes rent the cheaper option nearly everywhere. A typical rent payment in May is more expensive than a mortgage payment with a 20% down payment, including taxes and insurance, in just 5 of the 50 largest U.S. metros. In 2019, rent was more expensive in 28 of those metro areas. So only 5 metro areas remain where it's cheaper to rent. And I don't believe that. That's at a 20% down payment, right? Most people don't have a 20% down payment, but whatever. It goes on. Buyers finally bought. Price appreciation, according to Zillow Home Price Index, finally turned the corner after setting a new record highs for 13 straight months, as its annual growth rate dipped from 20.9 in April to 20.7 in May. The typical U.S. home is now worth $349,816, nearly $60,000 more than just last year, and almost $95,000 higher than in May of 2020. Do you guys remember 3 months ago when I said unaffordability was the biggest factor at turning this market around despite low inventory? Do y'all remember me saying that? Do y'all see what's going on right now? Unaffordability is the biggest driving factor. Now, obviously, unaffordability came because of interest rates and overvalued houses. I understand that there's a whole bunch of factors, but people can't pay. They ain't going to pay. It's too unaffordable. It's crazy to think that this is sustainable. I don't get it. But let's continue on with this article right now. And I like this one, y'all. This is about inventory. Go and click this link in where it says region name right here. This is actually a drop down. So you can actually select y'all's metro and see what's going on in your own metro. So for the love of God, you guys, please click the link in my description. Go to Zillow and check out your local housing market like I'm always preaching. Please make me proud of you. This article continues. It will take time to confirm, but for now, the trend appears to show that the market passed an inflection point for home values between April and May, transitioning from ever hotter to somewhat cooler price growth. This deceleration is a clear signal that buyers are dialing back their demand for homes in the face of daunting affordability challenges, and I will also say a lack of inventory and options. The number of for sale listings that went under contract in May is down nearly 20% from 2021, when the activity was near a 4-year peak and is 2% below that of May 2019. The median time on market for new listings is just 7 days, holding steady from April and even the last May. You guys, and here's the thing, we're in the end of June. So what do you think the numbers are going to be in June? It's probably going to continue the trends. It's probably going to be even worse. This continues. Inventory continues to recover. Total inventory for sale listings continue to steadily spring climb, making 10.5% growth over April, now just sits 14.2% below its year-ago level. However, new listings are rising at a slower pace, 5.6% month-over-month growth. This likely means listings are beginning to hang around the market longer, and the slowdown is contributing to the recovery of inventory. And here's what I want you guys to see. Look at the trend heading up. Okay, so it was all down, inventory gutted, and really gutted post pandemic, post COVID, just straight drop. But look, it's now trending up. So we want this to continue to trend up, right? We want it to be at, over 1.5 million listings, whether pending or active. And look at this right here. This is really intriguing. Here is what I'm talking about right here. Here's the equity growth, right? So at least it's shooting up. We need it to be higher, y'all, like up here. But look at this. This is kind of like a skyrocketing up. So inventory is kind of skyrocketing as it should this time of year. But, a lot of people didn't think that this was possible because of one thing: overwhelming demand. But what happens when demand is crippled and taken away? Inventory is going to naturally go up. And that's what we're seeing here, right? Obviously, demand crushed, inventory is going to come up. Now, inventory is going to come up last. So it starts with interest rates, then sales and construction, and then price and inventory. So we're starting to see each of those tiers now firing on all cylinders. Not every tier is, but we're starting to see these trends now. This is absolutely great news, you guys. This is what you want to see if you're exactly like me. And I believe a lot of my subscribers are. So congratulations, you guys. It looks like we're right, as long as the Federal Reserve doesn't flip-flop yet. Let's continue on with this article. All right, guys, so let's see Zillow's new projections here. Okay, so remember last week they projected 11.6% growth ending April 2023. The market deceleration has led to a downward adjustment from Zillow's forecast for one-year home price appreciation since April. The Zillow Home Value Index is expected to increase 9.7% in the 12 months ending in May 2023 compared to the last month's forecast of 11.6 in the 12 months ending April 2023. So you guys see, every time they do a new market report, they go down about 2%. So how much longer can they keep going down? Another 4 months before they have to say negative equity growth? But listen, you guys, people are supposed to trust Zillow. Zillow is supposed to be intelligent, massive technology company. They keep getting it wrong. They keep downgrade. What happens when they factor in a recession? I want Zillow to factor in a recession and then tell us, what do they believe price growth is going to be? Do y'all see what I mean? Let's go back to this article right now because I want you guys to see what they've made as far as inventory. Look at this cool little chart that they made right here. Up 10.5% since April 2022. Inventory continues to recover from recent lows, but is still 50% below 2019 levels. So on one hand, be happy about the 10.5% inventory increase, but we're still way too low for the market to properly reset. We're still going to need more inventory. I expect that to happen the end of August this year. So overall, my conclusion is this, you guys. Yet again, Zillow is overly aggressive. They're having to downgrade their forecast again. So tread lightly as far as their projections. But I will say thank you, Zillow, for this data. It is super helpful to analyze because we need to know what's going on in our housing market so we can adjust properly, right, y'all? But anyways, you guys, I appreciate you watching this video with me, and I appreciate you taking this journey with me. And if you're out there investing in real estate, I do wish you luck, and I hope you win.